thank you so much, everyone, for coming. Sorry, the room is a little bit tight, but it makes for a nice, intimate conversation, right? So thank you so much for coming. I'm Danny Delaney. I work at the Adirondack North Country Association and program coordinator for the Center for Businesses in Transition. Just before we get started and I introduce Victoria from the agency, I want to talk to you for a little bit, for a minute, to thank Susan Merrill for joining us from Ms. Gillibrand's office today, and being so invested in this kind of work. So much.
She's just going to be funny.
You have to ask her. I don't know. So before we get started, some folks may not want to be very public about their transition plans, and if you are a business owner or worker owner who's looking to do that and do not want your picture taken, now is the time to say no. I just want to double check. So I won't go into everybody's introductions. I will sort of let them do that themselves, but we'll just quickly say this program is being put on by a number of different partners. So excited to be able to work in partnership on this. So from the Adirondack Economic Development Corporation, co-hosting with us, the Cooperative Development Institute, Cooperative Fund of New England, the Onondaga Small Business Development Center at Onondaga Community College, and the Democracy at Work Institute. We also have some of our community liaisons for the Center for Businesses in Transition here, Angela Smith from the SBDC at the SUNY Kitten SBDC at Clinton Community College, and Russ Kenyon from the Franklin County Industrial Development Agency and Economic Development Board. Committee. I just Angela.
All these long
you guys have like 4.
That's why we have branding issues.
So thank you guys. But you know, we really look forward to today as a participatory conversation, and I'm looking forward to having everyone here for sure. And there are so many other people I could recognize and thank, but I think we should probably get started. And I want to take a minute to introduce and thank Victoria Dooley from the Adirondack Economic Development Corporation for joining us today as co-host of the program. Their mission is to provide access to capital, training, and technical assistance to North Country small businesses. They're our region's CDFI, and they're instrumental to the growth and sustainability of our economic ecosystem. And we're just really excited about having you on board in your new role and being here for this conversation. Thank you so much. Yeah.
So thanks for having me, Danny and ANCA and everybody here. I'm on the schedule just to say a couple key words about each to set the stage to start off the conversation. We're one of the many economic development partners in our region. We have been a nonprofit economic development organization serving 14 counties in the greater Adirondack, the exact same footprint actually as ANCA since 1976. Our mission statement is up there. Our particular niche is really empowering people to participate in their local economies through business. And we settled into that exact focus within economic development really about late 1990s. So we've been doing what we've been doing since then, about that time. Go ahead to the next one. I'll just say a few words about some of the areas that we do cover, and this is not about us today, so this is just a very quick discussion. But some of the ways that we do our mission, we do classroom training and one-on-one technical assistance. The key to what we do is trying to connect businesses to capital. That's really key to our areas of focus, and we do that through various micro-lending programs. So we're about micro-lending. We're filling in those gaps where they are not there through traditional institutional means. We work with our program graduates constantly in the businesses that we served before. Lots of times we're relending back to those companies to help them grow and it's success. And we also find that another measure of success is when our companies outgrow us and then we're bank ready, and that's a good thing. So sometimes we lose our clients, and that's the goal, right? So that's okay too. We work with a lot of underserved populations. We do certification for the MWBE program for disabled veterans to get them into the programs to receive the state benefits as well. Those are fairly long, slightly cumbersome, but important processes to get them into those programs. And then we work with local governments and regional governments in doing some economic and business development planning as well. So the last 3 bullets there are some of the areas that we hold within our tool belt that we can help to make some of those other pieces happen. So we are a federally certified and a New York State certified CBIT, or Community Development Financial Institution. So that's a big tool that we have to bring capital. And we are an SBA official micro lender. And so SBA loans are kind of our bailiwick in micro lending. And we are an ESD Entrepreneurship Assistance Center. So part of the network of 20 plus EACs that work with the small business community and trying to provide those resources to entrepreneurship and promoting that in our area. So that's kind of how we do what we do and the core of the businesses that we do. Advance the slide. So really for us, it's about the businesses. We know the work, it's really all about them. We know the work that goes into bringing them to fruition, and we also really know the dollars that come out of it, the jobs that come out of it. The scale is pretty small, but cumulatively to our small communities, it's huge. And so these organizations, these companies are building communities one business at a time, and over business by business. We all know this is that it's a massive impact. So we have a fantastic role. We love what we do, and being able to see these small businesses succeed, making those entrepreneurs successful, but also building the community at the small business level. So we love what we do. Last slide is just my contact information. Oh, it's really little.
It's also on one of your sheets. I copied him.
So there's my contact information. Steve Arno, raise your hand. He is here also. He's our loan director. He oversees all of our loans, basically, because so you can contact him.
So we were going to do this sort of high-techy poll thing, but I think I'm just going to do it on the whiteboard, on the white paper. Which so these are the questions. So, and we just want to know a little bit about who's in the room and why you're doing this today. So we can just do a quick hand raise for this one. So are you here as an economic development professional or business advisor? 2, 3, 4, 5, 6, 7, 8. Great. Are you here as a financial professional or representative from a lending institution? Current business owner? One. Oh, yes, one. That's fine. Great. I'm sorry, current business owner? And aspiring business owner? Elected official or from an elected official's office? Thank you. Interested community member, board member, any of those sort of 1, 2, 3, 4.
You have a business owner category.
Important to know.
Once a business owner.
And we can just sort of talk about this for a moment, if folks want to do that. So if anybody wants to share, and you don't have to do it now, but your interest in worker ownership or cooperative development. Yeah, taking volunteers.
My name is Jay. My company's Ward Lumber. I am this. What do I want to say? I'm a 50-something business owner that is aspiring to create a transition plan, and it hopefully includes my employee team taking over the business.
Okay, how did you get to that point? How did you come to that awareness and interest in doing that?
Well, I proposed it to my family 20 years ago, and I got the, you want to do what? 2 years ago, my brother and I reorganized our business, so I became sole owner of the Ward Lumber that people know. And then I spoke to my employee team about it, and I got the, you want to do what? But in the last year and a half, and with Rob Brown's help, we're really progressing. Does that answer your question?
I'm volunteer too. I'm Patrice from Goddess, and I have been interested in stakeholder cooperatives for a number of years, and was overwhelmed by the process of transition. which kind of felt daunting to me, but I do believe that cooperatives are the business model of the future. I believe in cooperation and collaboration over competition. And so we're interested in carrying out a business partner, carrying the business in that direction.
Does anybody else want to share their interest? You don't have to do this now if it's not the right. Yeah, there you go. That would help.
Corner here.
Yeah, cool.
I'm Lee Vanwater. I'm the here just to learn more about cooperatives and cooperative development. We are assisting them in developing forming engineering.
I have a question for you. Has the Potsdam Co-op always been a co-op, or was it a private?
No, it's been a co-op since its incorporation in 1993.
Anyone else before we jump ahead?
Gentleman asked me a question. I want to jump back to that. Somewhat to your question, a year ago, about now, Senator Gillibrand was at the ANCA office, and something on the ANCA Facebook page, I saw Ashley from
North Country. Yeah.
Thank you, North Country Creamery, who I'm friends with, and I saw her picture and started reading the article and went on the website, and about, I don't know, 2 hours later that evening, somehow I found Senator Gillibrand was coming in. So that maybe is somewhat of an answer to your question.
Yeah, that's another spark along the way that
Right.
got you to the current point.
Right.
And is there anything that you want to share that you're hoping to come away with from today's conversation?
For me, it's learning existing funding options for people looking at co-op models, but also understanding where the work needs to be done, for example, with SBA, with our local banks, to encourage them to look at these lending models. Frank and I with the Small Business Development Center, we're in New York statewide, but I serve the North Country. Frank, also a part of the North Country, and he's the only one in the entire state specialized in co-op models. Increasingly, this is going to come to our table, so we're trying to get up to speed in the North Country, and we're working a lot with Danny and the Center for Businesses in Transition to make sure that rural businesses successfully transition. We don't lose anybody here in the North Country.
Thanks, Danny. I'll just say the only person in the SBDC network, advisor network, maybe who's got the expertise and experience, but we do have this great panel today of a lot of other developers at the same time. And I think part of events like this, right, is not just connecting our professional networks, our peer networks for doing this co-op development work, but seeing where we fit and which lanes we fit in and how we can best serve together the needs.
Anybody else have objectives that they'd really like to sort of hit on today? Comes up later. It's totally fine. And we're going to skip this one. And we did that. All right. I think we're good there then. And I think more questions and conversation will come up as we go on. So Anne, I'm going to talk just very briefly about ANCA and sort of how this came about. This conversation came about, and then I'm going to stop talking and leave it to folks who actually want to hear from. So I work at ANCA. Most of you are familiar with our work, so I won't go too much into it, but we work to grow the new economy in the North Country in a number of different ways by promoting small businesses and clean energy and local food systems in a number of different ways. And so we try to move the North Country region away from an extractive economic model to one that's more sustainable for everyone. And we do that in local food, like I said. We do farm to school programs and help look at the food system as a whole. What do farmers need to make sure that they can actually sell to schools and institutions and things like that. We work in local energy and municipalities to help with questions about clean energy and LED streetlights and solar and that sort of thing. And then we work with local businesses in a number of different ways, including the Center for Businesses in Transition. But also we help small scale artisans who are looking to go to wholesale or make the craft or thing that they do at home into a real thriving business through the Adirondack Fire Days. We do a whole lot of regional advocacy as well, and all sorts of interesting work. And I'm not glossing over that, but I think everyone knows what we do here, so I don't, or at least has some good baseline knowledge. So, about 2 years ago, we started this project, but it was published as of this year to put together with universities and different organizations, one of them being St. Lawrence University, and other folks, to develop a regional economic analysis for our region to identify where some of the key sectors that we can go and work together to sort of identify as places where there's good opportunity for the future. And some of the things that came out of that were craft and manufacturing, local food and value-added agriculture, and sustainable tourism. One of the major things that we heard and saw from that, from both the interviews that we were doing at the time with community leaders and economic development organizations, as well as the report, is that it's a national problem, right? But there's a lot of retiring baby boomers. And in our area, we probably have somewhere between 10 to 16,000 aging out in our 14-county North Country region. So from that work, we developed a partnership called the Center for Businesses in Transition that focuses on helping those transitions, but really doing it by pulling all the people together that are already doing the great work in their communities. SBDC advisors, folks who are at their IDAs, the Workforce Development Institute, all of these folks who are really tied into their business community, learning what they're doing to help retain these businesses and help guide them through some of the options available. So we don't have a physical location. We have community liaisons throughout the region. But the goal of the partnership, and it really is a partnership, is to provide matchmaking services to potential buyers, access to planning tools, and connection with existing services. These are all of the folks that have a full-time liaison in their office, and some of them have boots on the ground people, right? The folks going, not necessarily door to door, but reaching out to their networks to let them know about the importance of business transitions at least 3 to 5 years in advance, thinking about succession planning and being able to provide resources and help them access educational opportunities. And so we have liaisons from these offices, but we have over 50 partners throughout the region who are working on this project, who are really interested and excited about partnering to develop in a number of different things. So we help folks with a number of different transitions and mostly exploring their options and connecting to available resources. So businesses looking to sell in the open market, intergenerational family transitions, and conversions to employee ownership. So that kind of leads us to where we were at. So yesterday, we were lucky enough to have a few of these folks join us at the Adirondack Experience Museum to do a sort of transitioning to worker ownership seminar that will be available online very soon, probably within the next week, and I'll send that out afterwards for folks. But that really went through the nitty-gritty of like what is worker ownership, what is a cooperative, how do we define that, is it something that might be right for you, and so those will be available. But one of the things that keeps coming up, so since we launched this program in January of this year, we've had 65 business owners reach out, 12 aspiring entrepreneurs, and 2 investors. Out of the 65 business owners, we've had a quarter of them ask more about worker ownership. So we're really excited that there's momentum building and people are interested and understand kind of what that is. And I think part of that is due to Ben's work in the North Country Symposium a couple years ago to sort of plant the seeds for that work. And so they know what it is, or some do, and there's certainly a lot more education to go around, but folks are asking about it and want more. And as they want more, as business owners ask more questions, we've heard feedback that they don't always know where to get the answers when it comes to the financing piece of the equation. So we're really looking to have that conversation today. So to talk about financing, kind of what that looks like, and how we might have a good conversation starter for other conversations to come around that question. Some of the things that Rob pointed out yesterday and Frank pointed out yesterday in their presentations, you'll hear more from them. And I think Frank has said that retiring baby boomers own nearly half privately held businesses with employees in the U.S. And that over half, and that makes 24.7 million employees. Over half of business closings are due to owner retirement, resulting in the largest single source of avoidable job loss in the U.S. And only 20% of business listings ever sell. and only 15% of intergenerational business transfers succeed. And one of the things that Rob pointed out yesterday was that compared to conventionally owned businesses, employee-owned businesses, cooperatives create 2.5% more jobs, are 1/3 less likely to lay off workers in a downturn, are more productive and profitable. And compared to conventionally owned businesses, employee-owned, oh, I just said that already, I'm sorry. Did you want to hear it again? There was another slide I was going to tell you about, but that workshop will be online and you can see it, like I said, within the week. And so if you want to know more about the sort of baseline, like what is worker ownership, how do we get conversions to get rolling, if it's right for you or your business or your clients, then that would be a good resource for you. But without further ado, because someone wants to hear from me, I want to introduce Joe Maripino of the Democracy at Work Institute. Joe Maripino is the program manager at the Democracy at Work Institute, whose mission is to expand the worker cooperative model to reach communities most directly affected by social and economic inequality, specifically people of color, recent immigrants, and low-wage workforce. I had the pleasure of meeting him last night and having a wonderful dinner. And I think what I really appreciated about having dinner with you last night was that I really heard and saw that you're just really the factors that you really see the factors that contribute to social and economic inequality, and especially in rural areas like ours, aren't necessarily always a cookie cutter fit for a solution. And having that conversation around really wanting to come in and have those conversations about what is right for us in our area, I just was really excited to hear that and excited to have you here today in that capacity. So thank you so much for that. This comes from Ithaca and Table Daughters.
Having you here and digging. So I'm playing the role of a facilitator of the conversation, and I have questions of some panelists here. I also welcome kind of interruptive style of conversation. So people say I don't understand. I want to have something to say about that. I welcome that, and I may also say let's hold that for later, or let's hear from other people. So to give a little bit of background about the Democracy at Work Institute, we're a national organization. We got spun off of a trade association of worker co-ops, 500 worker co-ops in the country. And about 5 years ago, this nonprofit spun off. I think people had always contacted the National Trade Association and said, I've been reading about worker co-ops. I've learned about Spain and Italy. And for many years, it was like the caricature was a guy in his basement who was calling. And then 5 years ago, it was like the mayor. And so there was a shift in the national atmosphere where suddenly the people who were interested in doing something about this were resource people. They were governments, they were economic development folks, and they were putting up a shingle outside and saying, we now support worker co-ops. But many of them didn't really know quite what that meant. And so we were spun off basically to help guide new development centers to have conversations with each other and to do it right, to follow best practices. And as Danny has suggested, when we started 5 years ago, we felt like we knew best practices, and so it was our goal to teach everybody what those were. And we discovered over the course of 5 years that the best thing we can do is to get people to talk to each other, because there are different best practices for different places. So we have a consulting relationship with a lot of big cities, with Miami and Atlanta and Philadelphia and Rochester, and then we also work in rural areas and work with rural development centers, and it's a little bit different in every place. I'd say when that shift in interest happened, there were kind of three things that were motivating it. One was in prosperous cities, there was unequal prosperity. So there were people who were being left out of the boom. And it seemed like there wasn't a path to the middle class for a certain people anymore. And there were certain officials who felt that wasn't fair, and they wanted to serve all of their constituency and co-ops. There was another kind of boost of interest from shrinking cities, places like Cleveland and Rochester and Detroit, where they felt like they were hollowing out economically, and they thought they could retain economic stability by forming co-ops in certain neighborhoods. And then probably the largest of them is the thing we're talking about today, which is this baby boomer retirement boom, in the sense that everyone is comfortable with these assets and business owners, and what was going to happen to kind of undermine the economy. So that one was particularly important because it has this sort of win-win-win value. It's good for the selling owner, it's good for the buying employees, and it's good for the community. So that is currently probably the most resourced of all of the things that people are interested in. So what we've been doing is trying to just produce best practice type guides, things like this, checklists and case studies. We continue to produce those, and we definitely depend upon the local centers to, provide information for them for new case studies that emerge in places like Placid. So that's a little introduction of why I'm here and where I'm coming from. So I'm gonna just kind of ask folks a couple questions, and I'm encouraging everybody to be short-winded, so that we can have a conversation.
Short-winded for one person, like nothing to do.
Yeah, answer these questions, a minute to 4 minutes. And there you go. So let's start with Rob. Rob, so you talk to a lot of business owners, and the question I have for you is when you talk to business owners, what are the things that they intuitively understand about employee ownership, cooperation, and they're like, I've been waiting for this idea my whole life. I've always wanted to do this. And what are the things that they don't understand about it? You have to say, well, you got it wrong. You can use other examples.
Well, let's see. So just with business owners, I think business owners, they understand it. They understand entrepreneurship generally because it very much makes up a part of their character. They understand usually and to a decent degree, they understand the capacities of their own employees. Not always and not to a full extent, but generally. And those things often will lead a business owner to consider this more or less. Sometimes a business owner thinks they've heard about it, and they think it's a little weird, or they think it's pie in the sky, but they think maybe their employees would be into it, so they're willing to put it out there. Sometimes it's the other way around. Sometimes it's the business owner who's really committed to this idea, and it's what they want for their business that they build, and the employees are like, there goes the boss, off on another one of these tangents. So in any one of those circumstances, all of that can be navigated and it plays out in different ways. Sometimes you get just the business where it's just a sensible, practical thing that everybody just thinks, yeah, of course, this would work. And it's very amicable in that way.
Is there anything universally misunderstood by the people you talk to, business owners or employees?
I don't know if I go so far as to say universally, but I think most commonly misunderstood. There's a misunderstanding about the nature of work and income in employee-owned business, and by that I mean a lot of business owners have gone through good times, they've gone through bad times, maybe they've been on the brink of bankruptcy and brought it back. I mean, it's been a seesaw ride for them, and that has impacted their personal lives. And in terms of their own work and income, working 80 hours a week for no income versus those types of type of roller coaster. And it's, if you're interested in converting your business to employee ownership, selling your business to employees, that's not an appropriate expectation to have of those employees. And I think that's the nice thing about employee ownership, is you don't have to have that expectation. The idea of shared risk, shared burden, shared rewards. Nobody's going to get rich, as we were talking about last night. Nobody's going to be driving a Corvette in a couple of years, but the ownership of work, the ownership of the business, the sense of voice at work, the sense of control, and yes, a share of the profits in the good times, and a share of the risk and the losses, the downtimes, can help people. Is a good way to share risk and reward and make entrepreneurship available to far more people than are the solo entrepreneurs. The solo entrepreneurs are very much a unique breed, and there aren't a lot of them. The vast majority of people are very risk intolerant, risk averse, and for people of moderate risk aversion, cooperative entrepreneurship is a good path.
How about let's pivot to Carolyn. So Carolyn, if you don't know her, is in because of a unique position. She was the CEO or co-CEO of a business that converted to employee ownership 4 years ago, and is now moves to a lending position at Cooperative Fund of England. So it has received loans and now is in a position of maybe helping to others to get loans. And the question I have for you is, what's different about lending to a worker co-op?
Yeah, I mean, as Rob kind of alluded to, one of the biggest differences, obviously, that you have a distributed ownership structure. So you're lending to a group, and so that has implications in terms of, underwriting and a whole host of things. And the other thing is that.
Can you just clarify that you're lending to all the individuals in the group, or you're lending to them as a whole, or what do you mean by that?
You are lending to the group, so in a case of a traditional solo entrepreneur going to, say, the SBA for a loan or an SBA bank for a loan, they're looking at that person, their personal credit history, etc. When we're lending to a cooperative, we're looking at it as a corporation that is comprised of a bunch of individual people, but each of those individuals might, say there are 20 worker owners, each of them owns a 5% stake. None of them are going to be able to personally guarantee the loan out of their own assets. And so that's very different in terms of sort of traditional underwriting and how we approach that.
So do the personal assets of those 20 people need to support whatever it is you're going to loan?
They do not at all, not in the slightest. And we'll get to that a little bit later. I'll tell you now. Okay. Yeah. So one of the things that's really tricky about lending to worker co-ops or being a worker co-op and trying to get a loan, a credit card, a new truck, is that nobody wants to put a personal guarantee down, because if I, as one of those 20 owners, am going to put my name solely and my house and my assets on the line, I don't have any additional power. I don't have any additional power or any additional return. It's one member, one share, one vote. So, there's nothing to compensate me for the additional risk I'm taking on. Full disclosure, I've done it because when we were starting up, we needed new trucks, we needed new Bobcats. Somebody had to do it, but we had to have some very hard conversations with the group about how were they going to make me whole if something happened. So, putting on my cooperative fund lender hat, we try very hard not to put co-ops in that position because it creates a lot of interpersonal challenges. We'd much rather figure out alternate ways to manage our risk by looking at, both getting more creative about collateral. What can we use to secure those loans? Is there inventory? Is there equipment? In the case of cooperative fund, because we're a CDFI, we can take investments and use the investments in cooperative fund to secure the loan. So even if the loan were to default and the investor who knows that they're putting the investment in to secure the loan, even if they were to lose that, they could count it as a charitable contribution to the fund. So it's basically a matter of getting more creative in a way that accounts receivable, absolutely. Contracts, if you're in a business like a landscaping company where you've got renewable contracts, those have a value on the market. So it's just understanding that every business is not the same. If you're looking at individual credit scores, that's kind of easy to take a cookie cutter approach. Whereas if you're lending to the cooperative as a whole, you need to sort of understand what's in their business that's of value and how could you monetize that if things were to go sideways.
So now in your transition, how are you having to transfer those personal risks that you took on as the executive to somebody else?
Well, so the cool thing is that because we've been in business as a co-op now for 6 years, we do have credit in the co-op's name. So by and large, we've been able to just contact our vendors and accounts and sort of say, will you just release me from it, and not ask somebody else to sign on, but generally said yes.
So let me put it over to Franklin and Angela to jump in on this one as well. So why the SBA and SBDCs all over the country right now are getting some of them have been for a while. They were champions within the system. But I know that there are conversations happening in the Northwest, in the DC area, and in this region. Why is the SBA and SBDC so interested in employee ownership? Right now, what's happening?
Thanks, Joe. Yeah, what was the spark, right? I mean, we know that part of the spark is the Main Street Employee Ownership Act that Senator Joe Graham was so successful in helping to get passed last year. And that has a direct correlation with the work that the SBA and the SBDCs have to do, a mandate, so to speak. And we're very happy for that mandate because, as Joe mentioned earlier, there have been SBDC offices and SBDC champions of employee ownership in different pockets of the country, but without sort of top-down leadership in a way for how to encumber the work of employee ownership within our agencies, right? It's been a very hard road to bring it to the surface. And so now we've got that ability. There is a group in the Pacific Northwest, there's a group in Northern California, one of our SBDC directors in Rhode Island, another group of people up in Minnesota. These folks who have been involved in this, are knowledgeable about it, have championed it in the past, have now come together, right? Because there needs to be some leadership within the SBDC to figure out how we're going to get it.
What is the mandate? What are you mandated to do because of the Employee Ownership Act?
Yeah, so
No.
well, from the SBDC perspective, we are a technical service provider for the SBA, right? We're one of the fund agencies that provides on-the-ground technical assistance and advising for small businesses. One of the things we do as a part of that, right, is the one-on-one business advising. We sit down with businesses throughout the week. That's the main thing that we do, working with clients, providing mentorship, research, looking at their business plans, helping them come up with the solutions, questions of the business plans, the financial projections, so forth, connecting them with lenders as needed and as necessary. So if we wanted to work with co-ops in the past, it was sort of in a reactive. And if somebody were to come to us with an interest in relationship, then we would certainly do that. Even though we might not have resources and skill set yet, many of our centers do that. Now we can be proactive. Right? Because now we have the direction to take our educational and counseling and advising work and include employee ownership. So, small things, right? I'm going to pass around some of these flyers here. You guys can please take one and pass it on. But this is just an example of one small piece of educational and outreach work that grows out of this Main Street law, this interest, right? And when people see a large group of individuals suddenly become interested in this, they get excited about it. So I was able to get a batch of these cards printed up because a couple of influential individuals in Syracuse came to the table and expressed interest in employee ownership and what the cooperatives, right? We had a conversation with our city's MWBE office director. We had a conversation with our Syracuse University Office of Community Engagement director, right? These folks are primarily and directly involved with job creation, right? Job placement. And employee ownership is an option, right? It's a piece of that. So what we're trying to do is to look at how we can take the ability to be proactive now, working and engaging with SBDCs across the country and developing the resources, tools, the pathways that we need to bring that to our constituents.
Building our connection with people like you guys.
Yeah.
That's a big piece of what we do. I think we've worked on employees buying their boss's business for a long, long time, but we're also hearing from some of our North Country business, in my case, which is the area I work in, that there's an interest in how do I explore this if I wanted, my employees to take over, or maybe they've explored the traditional route of transitioning a business and it doesn't sell. So maybe now all of a sudden cooperative or employee ownership model is a little bit more attractive to them. So now they're more open for that transition.
change in it from the. Got it. And in the past, if someone had come to you and asked you about it without this mandate, oh, we don't do that. That's not part of our.
Well, I would have probably called our research network, because they're fantastic, to give me information on how to form co-ops and what's involved. And of course, we've always had Frank, and I've been at the SBDC as a resource, and that would have been my first steps. But in terms of personal knowledge, of being able to sit down and have a in-depth conversation in my office, one-on-one with a client, I'm in the training phase of beefing up my tools and my expertise to be more helpful. But we know how to transition businesses and secure funding. So that model, I don't think, changes terribly, whether you're talking co-op or traditional for-profit business.
Rob, let me ask this to you then. And again, if you guys want to jump in with questions from around the table or clarifications, I can help. Shoot your hand or just speak up. So even though the employees may not want to take on the risk of a personal guarantee, usually they're asked to put up some amount of equity in the purchase of the business. From my understanding, usually they don't have that. Most employees do not have the cash to even put up 10% or 20% of whatever's asked. What do they do? What happens in that situation when equity is needed from the employees? That's not.
The nature of the transactions that we work together, and not everybody does this work the same. So I'm speaking for how I try and put this together. You're not relying on equity from employees. Even if you have a huge share price, it's still a drop in the bucket relative to the value of the business more often than not. What you are trying to peg that share price to is something that represents meaningful engagement, skin in the game, so to speak. And that's different things to different people, and in different businesses. It might mean something different, highly profitable, highly skilled trade versus baristas in a coffee shop. So that's a relative value. So just to say that to start with, you're not trying to create a transaction where you're relying on equity coming up from the employees to close the deal. We rely much more on seller financing. We can get into that. As for how even for small amounts, like even if you had $1,000 share price, most workers do not have a spare $1,000 kicking around to jump into the game. So we always try and structure it so that they can do it through a payroll deduction. Maybe it's $25 a pay period, $10 a pay period, $50 a pay period, something like that. And that is something that is accessible to any employee who chooses to prioritize that. We did a large conversion in Maine, and there were single moms, using public assistance who believed this was important to become shareholders of this corporation, and they were putting $25 and they put $7,000 aside by in a large grocery retail. Yeah. So I just, to keep things practical, I would encourage those who have access to the program or can vend these programs to push on the use of individual development accounts for these purposes. Because if you have a low to moderate income worker who can get matched savings, and those matched savings programs can be used for a share of work cooperative. That would be an impressive thing. I've heard others talk about that, but no, I don't think it's a public policy for that.
What about SBA microloans?
Yeah, so that's if so. There's that. The one transaction that we did that worked very well, and SBA National was very impressed to see because it was nice loan volume. Was we had, so Cooperative Fund New England was the primary lender on, this, well, you all have this sheet in your pack, and Rock City Coffee is one of the little blurbs on it. That transition, Rock on Main, about 30 employees, 2 distinct businesses, a coffee roaster and a cafe business. Cooperative Fund New England and the seller were the primary funders of that transition, that transaction. But for the $2,500 share price, an SBA lender called Main Street Finance came in and did use this SBA microloan program to whip out these $2,500 share purchase loans. The loans were guaranteed by the cooperative, but the individuals paid for it. So then instead of doing the payroll deduction to pay back essentially a loan from the business, from the cooperative to them, the business was collecting the $25 a pay period from them to make one lump sum payment a month to Main Street Finance to pay back these loans. You know, it was like a 8% interest rate, but these are 2-year loans. So, 8%. It was a $50 processing fee, but the business decided to pay that. The board voted to have the business pay that processing fee. So it worked out quite well, and it put $50,000 in equity in the bank at closing date instead of it being. That's another model that used an existing. I mean, I try to be as pragmatic as possible. I don't want to invent new things. So, like, what's out there that we can and make work.
So, going over to Frank here, my understanding of SBDC is that you get a lot of folks interested in taking a loan out startup. Sometimes they come in for growth capital. Is there any, do you get business owners who are coming to you to do exit planning and to do succession planning? And is there anything different about pitching loans to the SBA for the end of the business owners at the time there versus the beginning of the arc?
Well, yeah, so we see the 4, right? We see clients from all along there. In my experience, there's not nearly quite as many people coming in for the end of the arc as there are in terms of our total clients, but probably our impact clients, it's more important. There are people who have been in business for a long time, have investments there, and are really committed to providing solutions, right? And so one of the ways that we work with the lenders is on a very local scale, right? We develop these relationships with everyone you can imagine. We try to get out and visit the lenders on a regular basis, right? Have a face-to-face name recognition with them so that when a question comes up from one of our clients, whatever the case may be, we can have a direct one-on-one conversation. And so I don't think that there's much difference in the process overall. It's just that, certain things such as, so one of the things we were talking about dinner last night was valuation, right? As a component of services that somebody might need to sell business. So that certainly is a different sort of resource that that client would be looking for versus something as a startup, right? Unless they perhaps try to buy a business from something else. But one example recently that, a couple of examples recently, we had a couple employees of a machine shop come to us looking to buy a business. And the problem was that they didn't have a whole lot of collateral stuff, but machine shop obviously did, right? So we're looking for the right lender to look in that direction, and it wasn't being very successful with their former traditional banks. Okay, so we did look to a local CDFI, right? Now, so I guess, one hat off, another hat on, and just disclosure that I'm president of our local CDFI, Cooperative Federal Credit Union in Syracuse, Adirondack County. And so we end up doing that loan because we have special access to finances for that loan fund for that as well. A second example that I can give you is we had a gentleman who opened a hearth, fireplace, and stove store, retail operation, retail maintenance, etc. A couple years back, 4 years back, I think. And he came back to us now looking for the ability to purchase another business. So now there's one of his competitors that was in business retiring, right? And his opportunity now to take over that business. So valuation was one of those important tools that we were able to give him. Back of the envelope, obviously, valuation, right? Nothing that is technically legally standing that you might get from but so what are the specific areas, right?
I think just what I've seen from our North Country office, we're much more active than many other SBDC centers because we're rural, because we have ANCA and the Center for Businesses in Transition that have identified businesses being at risk of, leaving and closing shop. So it's been really a priority for our office. So we are doing increasingly more services, business valuation, conversations. Right now at the SBDC level, we can't capture that as impact. We are doing education to make sure to facilitate these transitions. So the goal is to get the referrals on the back end for sellers because we can capture impact when Josh created the funding. I've been having conversation with Empire State Development, our local IBAs, to try and understand, are you willing to look at funding for transitioning businesses? We're really not creating a new business, right? But, and in terms from Empire State Development, they're saying yes, because it's job retention. So there are certain priorities like that that they are willing to look at.
The question for Carolyn, even if this, even if they see this from Syracuse, who does it not reach who really could benefit? I know part of your job, as far as I understand, is that outreach to the businesses or the employees. They wouldn't actually identify as being candidates, but could really help them in their lives. What are your processes to go beyond the quarter page sheet and tell people, no, this really is for you. This really can make a difference. Who are we leaving out?
Yeah, I think a lot of the people who are being left out are the same people who are being left out of business development and economic development in general. So low-income folks, immigrants, people, formerly incarcerated people, people who are returning to the workforce for whatever reason. I think with co-ops, the bar is simply, both as with traditional business support, helping folks to bridge maybe a knowledge gap of what does it take to put together a business plan to even go for funding. So there's a knowledge gap there, but also knowing that a worker-owned cooperative might actually be a more accessible option than going it alone. So simply because people who are left out or underserved by our current economy might be, like Rob was saying, they might be more risk averse. They might not want to be able to take on personal debt. They might not think of themselves as having access to start their own business. But when you present the opportunity of pooling the resources, their skill set, their financial resources, however limited those may be, and forming a group and going as a co-op to apply for funding and develop a business plan, it becomes a little more accessible. It feels a little more doable. So
is it just the knowledge gap, or just the structure of a loan to more marginal business or more left out business? Does the structure actually have to be different for them, or is it just the knowledge gap?
The structure may have to be different in terms of, again, sort of getting creative if they're collateralized or whatever. And so, cooperative fund, one of the things that we've done is to have both what we call a launch loan. That's particularly to help people who, maybe they're working another job or two as they are trying to put together the business plan, and they need to be able to get paid to put in some work on the business plan, or they need to be able to get technical assistance from a co-op developer to help them do that, and they need funds to pay that person. That launch loan helps them bridge that gap and makes it a little more accessible. So we've got that program, and then also we have a loan loss reserve that lets us, because we have a mission to loan to underserved communities, we acknowledge that that comes with potentially more risk. So we have a loan loss reserve that lets us do things that might feel a little more risky, knowing that there's some cushion there. Yeah.
Please do that.
So specific to that and kind of related to what you hit on in general, Carolyn, do you have any thoughts on, so how do you reach those folks better with this idea and just in general? Because that's something I think we wrestle with a lot, and having just put in an application for CDFI funds and having to talk about how you reach those disadvantaged folks better. We talk the talk, but it's really hard. Do you have any thoughts on that from your
Yeah, I mean, we ended up creating a new position, which is this is what I do, and it's it's part technical assistance and training, but it's part kind of organizing. So it's really making relationships with grassroots community groups that have more credibility, that can identify what the opportunities are, who are the people who have that entrepreneurial spirit. So we're not in a position to identify that or have those conversations, but when we have relationships with community groups and nonprofits, then we can.
ANCA and your
Exactly.
diversity initiatives, because that's a tie-in. But I think you're not going to get there as good as we get with improving the technologies and being better about the trainings we're doing. That I think you have to have somebody who's out there, professionally, who's looking to connect to folks in their own grounds. So I think that's an interesting point.
And it's also being willing to ask, where are you and what do you need, rather than saying, this is our project, this is our product, this is what we do. Instead, I mean, that's sort of where both my position and launch came from, was actually going and interviewing a lot of both past borrowers and people who were prospective borrowers who, for whatever reason, we ended up not working with, and saying what happened, help us understand what are the gaps, and so really taking where they are.
And I think having a model, we can make this work with Ford Lumber. I mean, the tremendous success story, and that speaks volumes to people. A lot of people don't even understand it's fully owned co-op and consumer co-op. They confuse it. So, I mean, we're starting at a very, very beginner level. Actually, try and explain what the co-op is and what does it eat. Different expression. Didn't translate well, but yeah.
I just have a quick detail too, because the importance of diversity of each who are at the table, right? And we all, I think, would agree that case studies and success stories are a good part of that, showing people and allowing people to see other people who look like them, who are from their communities, etc., and have that success rate. So just a small detail went on in here. When I first got this back to the designer, all the silhouettes were of white collar workers, and so just a very small change, right, to indicate that this can be anybody, right? It's not just white collar.
With the mom with the kid.
Let's take this gentleman here. Somebody talking about all that we were looking for images to use for our marketing materials, and Adobe stock had almost 0 images of minorities at all, and especially in any kind of business. So it's a challenge to even find images.
And when you do find minorities, they're very pigeonholed too, right?
Or you've seen them before.
Oh, yeah.
Yeah, so I mean, the one other thing related to this, for us to be conscious of as lenders, I think, is that when we're taking things like credit and collateral and reducing their importance, when we talk about sort of the 5 C's of lending, character really rises to be the one that we're putting a lot more weight on. And I think it's really important for lenders to kind of be aware of our own potential biases, whether the person coming to us is a woman, a person of color, a formerly incarcerated person, recognizing what sort of head trash we might have about that, and being willing to put in the time. So, I think we were talking a little bit at dinner about how little time SBDC officers actually get to spend with their borrowers. And we have the good fortune of spending a lot more time. And the things that come up in terms of, how quickly do they respond to requests for additional information, or how communicative are they, or just being able to see that they're really willing to put in the work to make their deal succeed. That speaks volumes, where you may not, be pulling a credit score or seeing quite the amount of collateral it needs to secure the loan.
I have two, maybe I'll just do one right now. But so 7 or 8 years ago, when I first looked into transitioning to a cooperative, the research that I did, somebody gave me the amount of about $30,000 that conversion. And at the time, we were just like, where does that money come from? And we didn't have an answer for that, so we just kind of tabled it. Where does that money? Where does the cost of the transition money come from?
And just to second that, that's a misperception I have, that creating co-ops, and especially I think probably because of the ESOP models, are terribly expensive and complex, and you need attorneys. And so that was one of the things that I tried to better understand how that works.
I mean, probably two parts. How much does it cost, and where does the money come from?
Yeah.
Who pays that?
But I can take a shot at that.
$150 a month, right, Rob?
Yeah. So CDI is a nonprofit where we get a substantial amount of funding from the U.S. Department of Agriculture to do cooperative development work in rural areas of New England. So we sort of have a program that we market for the use of those funds that provides some amount of free and low-cost services at the front end of the exploration process, right, for any that calls. And then sort of by program area, we shift that. We're a little more focused than others. I am a little more focused than others because I want to feel like it's paying for an actual service instead of just sort of like phone call type conversation. There's also philanthropic resources out there. All that to say that there is subsidy for some of that cost. There is, we're dealing with businesses with cash flow, with resources. So I certainly expect businesses to pay something, and in varying circumstances, I expect businesses to pay more or less. And then just the nature of our organization and the resources that we have, and we're able to do a fair amount speculatively, and our business model is subsidize what we can depending on its location, sector, size, public resources or private philanthropic resources, and to the extent that we need to fill the gap with resources from the business, then we can attach a fee to it, and we can do that work speculatively. That's a moment when financing is coming to the table, money is changing hands. A portion of that cost can be borne by the new co-op and rolled into the financing. So it's a way to pay for the services that makes it sustainable. The seller can pay for some of the services out of closing proceeds. So it's a mash of sources, public, private, philanthropic, investment from us that gets recouped at a closing, sometimes a front end retainer from a business owner that for most business owners can get something for a retainer. So
how much does it cost?
What model are you looking at?
Yeah, I was looking at cost is, I'm not trying to quit, but it depends on what you're talking about. So, from our perspective, for just the cost of the development services that we can do, it really depends on the length of time it takes, the size and complexity of the business. But generally, it could be as little as say $10,000. It could be as much as $30,000. But the difference is, unlike with an ESOP, that's $30,000 out of cash flow, right?
And once, not yearly.
Yeah. And so for an ESOP, it's not right now. It's like 50 to 100,000 out of cash flow, and then 30 to 75 out of cash flow on an annual basis. So that's probably the reasonable cost of it, but we can subsidize that in a bunch of different ways. But and then I view our role as trying to minimize the cost of more highly paid services like lawyers, right? Like if you're going to go to a lawyer and ask them to draft you cooperative bylaws, that's a $10,000 bill right there. I'll do it for you, like for minimal money, and then you have a lawyer run through it and make sure the I's are dotted and the T's are crossed, and it'll be $750 to $1,000 or less. So there's that way of looking at it too. And then there's some things. Oh, and then my goal is to really bring in as much as possible the other services that are out there, like SBDC, right? So it is not the highest and best use of my time to try and work with a group of employees to write a business plan. I can do it, but it's not the best use of my time when there's a local SBDC office who can guide them through that. Or even like financial literacy stuff. I mean, I view that as one of the key skill sets in a group of employees taking over a business, is to work on financial literacy and create some baseline. Everybody's not going to even have bookkeeper levels financial skill sets, but they at least need to be able to look at a profit and loss statement and not flip out. Right?
So like you can
Yeah.
the training to that.
Yeah, like financial literacy and understanding financial things is generally not the highest and best use of time. Like
Right.
when there's others. Out there.
Yeah, 'cause you keyed exactly what I was going to try to follow up on you on, is that when businesses come to us, they often have many misconceptions about what the numbers are or what the numbers may be. And so to sit down with a business owner, look at their current cash flow and, some, back in the envelope again, calculations to start off and what that future cash flow is going to be based upon what their visionary business plan is for that, is a way for us to start narrowing down those questions and those misconceptions, right? It's not $50,000 necessarily to do this transition, right? It's more like maybe 10 to 15, and where do we go from there with, then, as Rob said, finding the specialists as needed, when needed, et cetera. Bring in specialists for worker ownership, education, bring in the lawyer, whenever that's needed, right? We want to be able to use our services and make sure that a business owner or a group of employees coming in has that first level of understanding, right? Clear. There's misconceptions are swept away.
And then can you provide, like, with a conversation on business, can you provide an estimate of that, like, cost of transition? Early on in the process?
An estimate.
Okay.
It also heavily depends on the nature of the transaction itself. So, like Ralph's example yesterday, this Ace Hardware down in Stamford, New York, did a transition. He had it right down to the penny, all encompassing.
He was very financial.
Yeah, he was funny. But he had it done. He was like, this is what we paid CDI. This is what I paid for, this is what we paid at closing. This was the monthly fee we were going to pay afterwards. This is what we paid the lawyer. This is what we paid for, like, the transaction fee with the bank. And, and he was prepared, but his point was that it was a low-cost transition because, number one, he was just so good at cultivating his employees. Number two, it was 100% owner financing of the stocks. So it was just a very simple transaction. So the cost of the transaction were minimized, the amount of effort that went into it, the amount of time, and the amount of lawyers' fees. And
So we did a lot of work.
yeah, they.
There's cost of the transactions. The embedded cost is that you have to form relationships. So that is where the cost actually is. And once you form the relationships, everybody's cost.
I wanted to speak to Wendy Kate's question a little bit and share my experience with Rob specifically. And Rob provided a ton of information to me, fielded many phone calls, many text messages, many emails. Before we engaged Rob formally, Paul and Dale are part of our steering committee. We went to the Vermont Expo that's coming up next week, I think it is. All of that was no charge. So there was a whole lot that we gleaned out of this process before I was ready to commit and maybe our employee team. And then we paid a retainer, which was very reasonable. And then it's a % of the sale, which seems reasonable enough. So, the lawyers and accountants, I don't know what that's all going to be. That's the hard part. But I guess I want to pitch Rob and CDI that this is really reasonable. And Paul, can you speak to, from the employee team side, how you're finding it?
And again, using Rob specifically, we have questions, he answers us, and it's very hard to get that kind of service without the thought of, God, what is this going to cost?
Right.
And that really hasn't been a thing, which has made us much more comfortable to ask questions and to use the resource.
Because you operate much like an SBC would, where you're paying there's no charge.
There is a charge, but I make sure and scale it to the business and find other resources to build it out. So, and to your point, the post-transaction is as critical as anything that happens prior. So, I won't work with a company unless I very explicitly, the owner and the buyers are committed to working with them for some period of time afterwards with a retainer. But it's for that very reason that I do it that way. Let's figure out a reasonable monthly retainer, build 2-year contract, something like that. And then that way you never think that when you email me or call me, we got to keep it to 15 minutes.
$1,000.
No, just asking you a question, and I'll answer. If I got to come out there, I'll come out there. If you're going to get on Zoom or, so.
That's true with technology now. It really can help, I think, with some of those costs.
I'm going to put one more question in Carolyn's court, and then you can open up to kind of general questions to go on to that. So from what we say, most of the transactions, maybe 75% of them or more, have some aspect of seller financing, not just financing. Sometimes it's 100% seller financing, sometimes it's 30%. And you are an outside lender whose mission is that these deals happen. But what can be good about seller financing? What can be helpful, and what is sort of a red flag to you? Is there anything about leaning too heavily on the seller to finance them versus an organization like your own?
I think on the what's good about seller financing is certainly that, again, in looking to assess risk, one of the things that's cool about co-op conversions in general is that you assume that your buyers know the business intimately and have a good sense of what risk they're taking on and are uniquely suited to continue that business. But also, if the selling owner is willing to put a substantial amount of their, take a substantial portion of the cost as a note, they're assuming some of that risk. And so they've got some skin in the game long term to make sure that they're supporting that deal and that they're not going to just sort of take off with the brain trust and the proceeds. So I think that's why we like to see some portion of seller financing. And frankly, a lot of times we just even though we are, mission-based lenders, we can only assume so much risk. So sometimes it is just necessary to make the numbers work out.
Is there a rule of thumb you have about the percentage that you'd like to see there? And what about 100% seller finance? Is there anything about that as an outside lender? Ooh, don't do that. Is there anything wrong with 100% seller finance deals? You don't know? Okay.
Sorry, we just hit my bakery. Well, no, we wouldn't have anything to do with it, which may be why I don't have anything.
I guess what I'm wondering,
okay, let me say a thing coming from, like, putting my worker owner hat on, from the experience that we had with the yard and a half, is that, the seller has to be very conscious of how they hold themselves throughout this transition and afterwards. Because having an owner who has a hard time letting go of the reins can really, hobble the new co-op. And I think, one danger of having too much skin in the game is that would create an incentive for the seller to stay extremely involved, really micromanage some decisions, and, maybe not transition things as fully to the new management. So I think, that would probably be the downside, is sort of how much power do they have financially to hold over the
That's not
head
the way I
of the
would
new
do it.
worker owners.
That kind of comment. That's not the way I would do it.
Yeah,
And it
yeah.
makes the new
Yeah,
people say,
or I mean, not only that's not the way I would do it, which, I mean, that might be a legitimate thing to say sometimes, but you can't do it that way because you're putting my money at risk by doing so.
He's taking all the risk.
Yeah.
I'm just curious, the models, maybe there's some variation, but is when you're transitioning to work owner, does the original owner, the single owner, stay involved sometimes, or do they sort of fail and they, what?
Yeah, it's very variable based on the particular conditions. Whether it's a sort of emergency, Rob gave some really good scenarios yesterday of either somebody hasn't sort of thought about succession plan in advance, and all of a sudden they either just are done and burnt out and want out or ready to retire, or God forbid something bad happens and the employees are forced into a position where they need to assume ownership all of a sudden. There are times where you don't have the luxury, but I mean, certainly I think in most cases it's ideal to have a longer transition where the owner can really train people up and be thoughtful. I mean, in our experience with the yard and a half landscaping, the owner knew probably 5 years ahead of time that she wanted to sell, and most of the things that you're doing to get ready for a sale, whether it's to an outside buyer or your employees, are the same. You're working on making sure your financials are good procedures, good management team, etc. And then, it probably took about 18 months where she really made a conscious effort to educate new management and, sort of pass the reins on.
The traditional businesses, the transition, the securing the funding piece is often what takes the longest amount of time as well. When we're working with co-op models, it seems that financing piece is even more challenging unless the owner holds the note. Is that takes longer, or what are words of wisdom with that? Because that's the piece that really I think is the most difficult. Being here in the North Country, what are my resources that I can turn to help facilitate a transition of a for-profit business to a co-op model or loans? I don't know, the banks won't touch this right now, So where do I turn?
Let's see, Frank is trying to turn to both kind of institutions for loans.
Yeah, well, I mean, it's really great to see AEBC here, right? Development Corporation. Great to see multiple CDFIs here who have been mission-based for many, many years already and can easily slot into, cooperative lending.
All the way here? Or are you regional?
Well, I mean, this is AEBC is your region-based CDFI, right? Our CDFI in Syracuse works in multiple counties. We participate in loans with Alternatives Credit Union out of Ithaca, covers sort of that central New York region, and we do urban and rural. But the point that I wanted to make is that we have players that are existing, and we have them at the table, and so those banks, the traditional banks that are having problems with this lending, they're going to need to come to the table at some point, right? Because we're growing this movement, we're growing the number of businesses that are converting and are transitioning. And if I were to speak from my CDFI, we have a limited pool of 600,000 from the recent API money that was down from the governor, and we've went through that already, right? Character-based lending, as we were talking about earlier, And so, right, who's going to make that next loan for one of these projects that are character-based, whether it's a cooperative or not? Right now, we might need to turn to a traditional bank, right? And if they'll see hopefully they'll see the successes and examples that we've accomplished. And so it may not be there now, right? But we are building that capacity for hopefully these other lenders at the same time.
Yeah, I'll just add to that quickly that, even though we are the Cooperative Fund of New England, we're making an increasing number of loans to co-ops in New York. But also, I really challenge other CBFIs that, what we're all doing is very similar. So it feels like with some additional conversations, those relationships should be able to happen.
I know I talked yesterday to our Essex County IDA, and they're looking into it with their attorneys to see if that's something they can use their funds for. But they didn't know. So, we're posing the question to see, if that maybe it is. So that would be an option.
We've got one more question.
It wasn't a question. I just wanted to introduce Mr. Anthony Placid, the speaker for this evening's event, and many of you I know are joining us, and he rolled it for the last half hour up from Virginia. It's anyway, he doesn't want to sit. But just want to let you all know that he was here. But if you don't get from other and anyway, here you go.
One more over here.
So as a seller, I'm wondering what lenders like Co-op Fund or others expect of a seller after a transition. Any guidance on that?
I think the biggest thing is whatever you have agreed with your transition team that you're going to do it.
As far as continuing involvement, though,
Yes.
is there a good rule of thumb?
Again, I think it depends a lot on the relationship and the goals of both the seller and the co-op. But I think generally there's a benefit to continued involvement, availability, etc.
And I made that commitment to my team. I'm just curious how that affects lending.
And I think I actually at the very top of this, when you asked the question, just make this point out. It's critically important to distinguish from the seller's perspective, to distinguish between selling a business and retiring. Those are two separate things. If you try to do them at the same time, you very well just close. You can sell a business. It's the distinction between the ownership of the business and managing the business. It's the distinction, and the employees need to understand this in every level. The seller needs to understand this. The lenders need to understand this. The distinction between the ownership of the business, the governance of that business, and the management of that business. So, one day, Jay owns Ward Lumber, and then some other employee structure owns it. Employee-owned structure may own it, but that doesn't say much, if anything, about the governance of it or the management, the operational day-to-day management of it. So, if you want to encourage sustainable transitions that don't require massive amounts of external intervention, you want to encourage these staged transitions that sequence, like an ownership transition, and then do a governance transition, requires a little bit of board training, some membership training, let them practice, get their legs under them, and then think about an operational management transition. And that's really what we try and promote, and it works well. Everybody sort of is able to get their feet wet, and then get their knees wet, and slowly move into the pond instead of jumping on the dock.
The hardware store said it very well, where you go from wearing your owner hat to consultant. And he says, I have to remind myself every day, it's not my business anymore, I'm a consultant. So that's kind of the mindset. And I thought that illustrated it well.
Yeah. And it's different in every business, but just to constantly reinforce that distinction between who owns the business versus who's running the business. And just at the end of the day, it is still a private sector for-profit business, and people want to make a good living, right? Like, they're not looking to give away their labor. So, there is a desire to make money, and that's very profitable, if not more profitable. And that requires very good management. The one thing that I impress upon, particularly in some of those first conversations with lawyers, with the business owner, is And not everybody agrees with this characterization, but the idea that cooperatives own businesses, they don't run businesses, managers run businesses. And maybe it's a management team or co-managers or something like that, but large groups of employees don't get together and manage a business. A manager or some sort of management team that is recognized as such needs to do that.
I think we've come to the end of the normalized time, so I want to thank Rob and Carolyn and Frank and Angela and everybody here for participating in the conversation. And I think you want to tell us what happens next?
Sure, yeah. So I just wanted to let folks know that we're going to sort of have a follow-up conversation with the New Economy Project, who's looking at some campaign and legislative stuff around cooperative transition. So if you're interested in that kind of thing, that'll be coming up on July 18th, and I'll send out some information about that as well. But in your packets, there's information for all of the folks who were able to sort of join us and speak today. If you want to kind of contact any of them directly, please do that. Or if you have any other questions from the Center for Business and Transition or ABC, we're at your disposal to do so. And hopefully, as we move forward, we can get more financial institutions involved in the conversation. And so if you are a business owner looking to transition or looking to speak with a bank about this, please ask them to come to these conversations or contact us, and we will try to, happy to beat that drum and really try to have that conversation with as many financial folks. Thank you so much, everyone.
Thanks, Joe, for holding this space.
Yeah,
Thank you.
if you are